If I hear one more time that the Hindenburg-Omen breath signal is going to crash the market, I might just lose my mind. Yes, it's bearish, yes, it has a history of signaling market tops, but it also has a history of being completely wrong, like any other highly specific and niche signal. Instead, I think it's much more pertinent to simply monitor the trend, monitor how the AI names are doing, which I get it, that's breath related, and what's going on with upcoming catalysts. Palantir earnings on Monday check 2 of these boxes, for example. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of these data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY monthly time frame now that the October bars have officially closed out. Thank goodness, October was one heck of a month. But here we go. In terms of candle structure and location, solid green-bodied bar, very minimal upper and lower wicks in relationship to the size of the candle body. This is bullish. If we're thinking about candle location on the bar-to-bar count, we certainly have a higher low and a higher high, and a candle close completely outside of and above the previous month's range. Bulls go 2 for 2 on the bar-by-bar count here from the monthly point of view. Now, obviously, this is just brand new all-time highs in the market. The monthly trend remains firmly in the upward direction with lows, higher lows. This was a firm higher low. This obviously undercut that. So if this is the last major low, there's clearly room for a higher low on the monthly time scale. And I would still just be a fan of the previous all-time high area around roughly 613, 610 on the Spiders Cash ETF. If the monthly chart pulls back, there's plenty of room to offer a higher low, which is very important. What this means basically is that it would be incredibly hard for the market to quote unquote crash from this current configuration, because as we know and we talk about it every single time we have a monthly bar close, really bad things happen in the market when the monthly trend flips to down. Here is the dot-com bubble bursting. The monthly trend is down via a monthly lower high. You could call this a double top. You could call this equilibrium. Of course, you make the lower low. Bad things, really bad things. You could take the same approach in the Great Financial Crisis. I know it might sound redundant, like a broken record. We talk about it every single month, but it's worth reinforcing. Here's your lower high, here's your lower low under the neckline. Really bad things happen once the monthly trend actually flips to down. You'll also notice in both of these instances, right, the lower highs are underneath the monthly 20 SMA. So in terms of the strength of the trend, as we just scroll back to recent price action, are we anywhere even close to taking out the monthly 20 SMA? The answer is no. Let's take a look back here at 2022. Here was the lower high. It wasn't under the monthly 20 SMA, but certainly as we broke to a lower low from here to here, that is at the monthly 20 SMA. Notice that in this situation, the lower high actually formed a little bit of a head and shoulders on the monthly time scale, and there is a clean trend reversal. We're just not even close to that type of look here from the monthly perspective. I'm not talking about what happens on Monday morning. I'm not talking about what happens into Friday's close next week. I'm talking about a monthly view of the market here. Let's come in with a couple of Fibonacci's just to reinforce a couple of pullback levels from the April tariff lows up to the new all-time high. The 38.2 has finally, because of the brand new highs into the gap up of last week, basically, the 38.2 has been dragged higher to be confluenced with the previous all-time high set around that 610, 613 area. That would be a beautiful spot for a monthly higher low if a pullback were to emerge, which, as we talked about on the bar-by-bar count, there's really nothing here yet that would be indicative of a pullback right around the corner. Monthly structure is bullish, bar-to-bar count is bullish as well. In terms of a Fibonacci extension, I found this to be fairly interesting. If we come from the last major low back here before this nice bull run to the highs and then the pullback low from the April tariffs, notice that we are at the 100% extension from a fib perspective. Now, what we'll see in the NASDAQ is that we're actually already through this equal or sort of equivalent rather reference point. So it doesn't mean that the market must pull back off of this area, but if the market's going to pull back, is this a reasonable spot from a fib projection point of view? Sure. Now, would I just blindly start shorting the market because of that? No. And you could also see here that the fib 61.8, which obviously counting from here to here is going to be the same thing as the fib that we just pulled from a retracement perspective, April lows to the all-time high. It's right there at roughly that 610, 608, 613. It's a nice zone for a monthly higher low. So all things considered, looks pretty darn good here on the monthly. Pullbacks are fine, continuation is fine, no issues with the higher time frame trend. Let's take this thing down to a weekly time scale. Let's continue to get granular, and this is going to offer a slightly different picture, obviously, as we zoom in and take a look at the candle structure. This is clearly different. This is not a solid green bar-bodied bar. It's not a solid red-bodied bar, but it's definitely more of a reversal candle, right? Large inverted hammer at the top end of a trend after a gap up. Could this start to signal a little bit of exhaustion? Perhaps, right? What this tells us basically, because we have a red-bodied bar, is that the open is over the close, or you could invert that and say the close is under the open. So we know that buyers caused the rally, producing the upper wick, the new highest high in the trend count, but then prices pulled back and sellers were able to move through the opening print for a close weaker in the lower third of the weekly range rather than towards the top end of the weekly range, never mind even being over the opening print. So bears do have a little bit of an edge in terms of weekly structure here. If we're thinking about location, though, that edge completely disappears. We know that we have lows. This is clearly a higher low, almost completely outside of, it is actually outside of, the previous week's range. And of course, we have a higher high, and we still technically closed, although underneath the opening print, above and outside of the previous week's range. So there's really nothing here other than the possibility of a pullback that would indicate a firm trend reversal on the weekly timescale. Especially if we're thinking about the trend count on the weekly timescale, we know that this is a major low, soft higher low, major low, soft higher low, soft higher low. It's really been soft higher lows the entire way up because we have not fallen into a daily downtrend through any of this. So the level that I would continue to monitor here, there's really two, is the top end of the breakout range. That's the bearish engulfer high from back over here. And that number is going to be around your 670 if we're using opening prints. And then down here at these lows, we recall this number. Actually, I have to mentally recall what that is by hovering my cursor, 654. Right? It's been so long since, it's been a couple weeks, but it's been so long, quote, since we've traded at that level that I've forgotten. Anyway, 654 is the number that we care about. It's the bearish engulfer low. It's 4 equal lows, 1, 2, 3, and 4. If we take that out, then fine, there will be a weekly trend reversal, but we're just not there yet. We can come in here with some different Fibonacci's relative to different weekly anchor points versus the monthly. From the low of the China gap up deal to make a deal to the new high, you can see that the Fib 38.2 is kind of arbitrarily between the two key levels now. Remember that we were using this back here, the top end, what was acting as resistance, acted as support. That was still going to be a critical area around 638s. I wouldn't be as interested in that as of right now until we actually break down underneath the 654s. If we break down underneath the 654s, the point of the exercise is to just say, because we have this brand new highest high in the trend count, all of this could qualify as bull flag consolidation on the weekly, and I would still remain bullish in the higher time frames, looking for continuation of the overall trend, perhaps building out some balance over the weekly, 20 SMA here in orange. If we were to get a deeper pullback, yeah, I mean, the 61.8 line in the sand does unlock thinner structure to the downside. I just don't think it's really a conversation point for as of right now. Let's come in here. What else can we do? Let's go anchored VWAPs on the weekly time scale to see where we're at. Obviously, we'll be over the entirety of the stack, but where are the references? I mean, just beautiful. Notice how the top of the stack is starting to align with that key level around that 654. If we were to get there, maybe we'll have some larger concerns, but we're just not there yet. Let's take a peek at the volume profile. Obviously, there's not going to be much ahead of us because this is blue sky territories, but where's the high volume node for support below? It's kind of in the midpoint of this multi-week balance range. It's probably, well, it's not probably, I know it is. It's the top end of the junk drawer, which we'll talk about on the daily time scale, which wouldn't be the ideal higher low, but it still would be a higher low. Let's take a look now at the daily charts here for our S&P 500. We'll begin with the weekly expected move as we typically do, and that of course is our zone here in gray. If you're not familiar with this study, you can check out the video tutorial in the top right hand corner on how to set this one up. If we're contained by the upper bound, the number's at 692.93. That's a higher high and a brand new all-time high that is bullish. And if we're contained by the lower bound, the number is at 671.19, and that is clearly a higher low relative to the engulfer low. It's also a higher low relative to this pullback from what was a Wednesday session of now 2 weeks ago. What I'm most fond of with the expected move here for the week is that the lower edge is right at or right near the daily 20 SMA as well as the top end of the bearish engulfer high. So in my view, this is a bullish expected move offering continuation perhaps of the trend outside of a massive catalyst that would break back down underneath that level. So although yes, the expected move is forecasting that this zone will be important, I'm not just going to sit here and blindly buy this level if there's no sign of pullback buyers stepping up there. In terms of the trend count, this of course is the highest high in the trend count. It's a bit of a tumultuous week, not really doing anything all that impressive. If you take the Monday open, actually, just do something like that. And we saw this on the weekly bar, right? The candle body of the weekly bar was very small. it's practically unchanged. Markets tried to move higher, they kind of failed, tried to move lower, fill in some of the structure, failed, gapped up or opened higher on Friday, closed kind of middling. Really unchanged week here. So coming off of the highest high in the trend count, not really seeing follow through with momentum in the upward direction, it would seem reasonable to me that the market may try to firm up some of a footing for a cleaner higher low over this level. The candle structure in here is not all that compelling. Once again, remembering that we opened here and faded. We made a new 2-day low on Thursday. We opened higher on Friday, indicating that anybody who shorted the low of Thursday's bar kind of feeling like this, right? And then Friday's volatility just brought us right back down. So instead of squeezing the shorts who were short late to the party at the low of Thursday, you actually just closed unchanged. So in my view, what does this tell us about the types of participants getting involved in this market? Momentum buyers seem to be kind of on pause for now. Don't get me wrong, the gap and go was driven by momentum buyers, but that party seems to have at least taken a bit of a pause as of right now. I wouldn't also say that we have strong new money sellers here. If that were the case, you probably would have closed the gap all the way on the Thursday breakdown. Notice that there's still a little bit of yellow zone in here. Stronger sellers should have no issue rotating through thin structure just being the gap, and it just didn't happen. And then notice again on the Friday session, as we take out Thursday's low, there's no follow through to close the gap. That's kind of, I don't want to say insane because anything always goes in the market, but if you're thinking that stronger sellers are finally going to offer a pullback, the gap structure is like the no-brainer. All right, let's close the gap and then reevaluate. Again, you looked into the very little amount of gap that was still left, and sellers couldn't make it happen. So my base case here going forward into this week is primarily consolidation up here. If we do pull back, this would be well within the realm of possibilities. I would really evaluate to see whether or not buyers step up here at the lower edge of the weekly expected move, the daily 20 SMA, and most importantly, just turn previous resistance here from the bearish engulfer, this resistance for the consolidation, into newfound support. So that key zone, I would definitely treat it as a zone. The previous all-time high is at 674, and then the gap closed to the Thursday high of now 2 weeks ago is at 672.65. Let's get a little bit more granular. Let's take a look at the hourly time scale here and continue to build out a game plan for the upcoming week. You can kind of see here how choppy this was, right? If you're a stronger seller, let's zoom way in on this actually. Let's take a closer look. That gap structure is kind of throwing things off. Let's do this a little bit. There we go. That's not bad. So if you're a seller, this is what I'm talking about. This is all thin structure. This was the full gap from the Monday morning open. On what was it, Thursday morning, lack of follow through. And then, okay, lower high, this is where sellers should have had the most strength, so to speak, building on the perception of a lower high under the FOMC volatility. You close weak, and then to open here on Friday, support, fail. What did I just draw? What is this on the hourly time scale? If the market and S&P 500 cannot find acceptance, I would argue underneath the Sunday open low, which was from the Sunday when, of course, we heard from President Trump that things were getting better with China. That's going to be a key level walking forward, that Sunday night open. If we're over that level, I would not be an aggressive bear here. And once again, I would take that stance of balance to neutral, looking for consolidation in here. Brigade bolts up and over 685, look for the all-time high, and then Brigade bolts for continuation in the upward direction, continue to push prices slightly higher. That's sort of the base case that I'm working from here. If we do move under the Sunday low, this would be bearish consolidation. I don't even know how attractive the short would be through here. For me, the better short is likely looking for an intraday scalp on a move underneath and into the gap from the Friday session of now 2 weeks ago. If we were to get underneath 675.60, then the trade to short from quickly, A to B, is a scalp, and I do not overstay my welcome at point B. From there, I actually change tone back to bullish and would be looking for this outcome in the upward direction. How can we find buyers at this zone for the daily higher low that we were just talking about on the daily time scale, and how can we participate on the long side of the market there seeking these upper targets once again? That would be trend continuation across the weekly, daily, and heck, even the monthly at that point for the beginning stages of November would not have any threat of flipping to down. Now, there's this blue line that's slightly off the screen in the upward direction that you may or may not be able to see. I do want to address that really quickly. It's the measured move from the bearish engulfer, right? We talked about this a little bit on Wednesday's midweek market update video, but if this is a balance range, typically a range double is the measured move target. Okay, this comes from the engulfer high to the engulfer low. That is your 2x target at 695. I'm not saying we have to go there this upcoming week, but it would be a reference point in blue sky territories that may be useful if the market catches a bid and continues into those new all-time highs. Let's come in here with a couple of additional indications, such as the Fibonacci's from a few key reference points. As a matter of fact, let's start from the last major low on the hourly chart to the all-time high. Notice that the Fib 38.2 is spot on the money where this pullback has come into. To me, that's very nuanced and bullish indication. If we could hold above that, there's no reason to be an aggressive bear. You can clearly see that the fib 61.8 right around in here is confluence with this previous level. So the first takeaway is that if we were to pull back into that level, the fib 61.8 is helping us find buyers, or helping us build the narrative that this is a reasonable location for buyers to step up. Now, the second part of that is if you fail the fib 61.8, what does that always indicate? It's kind of your line in the sand from a fib perspective. I would expect the odds of 100% retracement towards this low dramatically increase. And that would be bearish, getting back down into much deeper the bearish engulfer range from back over here. That is the fibs from the major low. If we come in from the gap up, the first one, Friday's gap up, notice that the 61.8 has been closed above, and it is confluence with the Sunday low. Once again, kind of aligns with chop and slop through here, bullish above the fib 38.2, that's that 685 level we just talked about, and then bearish below for maybe the drift to the full gap close. Not mega bear, but just looking for that gap close to come into play if we take out that Sunday night low. Great confluence there with the levels. Final, last but not least, let's come in from the high to this low here, and what we can see is very similar, but the fib 61.8 is that 685. This is about 75 cents higher. If you take that out, the odds once again dramatically increase for the 100% retracement. Just talking about the bullish action if we were to retrace over some of these consolidation highs. That's the fib perspective. Let's take a quick glance at the intraday anchored VWAPs, and what we'll notice here is that the stack is this pinch point. Okay, the purple one is from the not FOMC, but the bearish engulfer and the big Trump tariff debacle back from Friday of 3-4 weeks ago now. But other than that, notice how this is just a pinched cluster. What does that continue to reinforce? In this zone, it's probably not so clear. It's probably not a great spot to be trading. If you can clear the stack, then great. You're probably looking at the all-time high. If you drop the stack, that pullback seems reasonable, and lo and behold, there is your tariff debacle anchored VWAP in a nice purple line. All right, that is what we have from the spiders intraday, and that is the pathing in a nutshell. Once again, if you want to keep it simple, nothing to do in here, let the market be. As in if we start to get underneath the low of last week, definitely looking for a pullback towards the gap close. When and if we get to the gap close area from the Friday session of now 2 weeks ago, 672.65, then we are looking for a higher low on the daily time scale. Let's put the DHL shipment in here just to be thorough in the analysis. If we were to get something that comes up here, this is probably bullish. You could probably look for the long on this type of move there over 685 into the all-time high. But then this is just bullish consolidation. Might be tricky to trade still. This is where things open up, targeting that bearish engulfer double at 695 in the upward direction. From there, monitoring for continuation. Now, I do want to go back to the daily chart for just a second because, of course, this is the thing that everybody wants to hear. It's, oh my God, the market's going to crash. How is it going to crash if it's going to happen? Well, my view would be that we would not find buyers here. If this market pulls back far more aggressive than I'm anticipating and starts to look like this, then of course everybody and their mothers, brothers, sisters, second removed goldfish is going to start talking about the possibility of a head and shoulders. Just like back here, everybody was talking about the possibility of head and shoulders. When and if that takes place, I will change my tone, but until proven otherwise over the bearish engulfer high, there is no reason to be an aggressive bear. That's my take here on the S&P 500. Let's take a look through some of the additional supporting evidence. Here are the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see here? The volume flows on Friday actually became somewhat more helpful. All this week, we were dealing with a divergent breadth, right? As the market was trying to grind in the upward direction, primarily Monday, Tuesday, breadth was horrific, right? You did not see volume participation. Then FOMC kind of kicks things in the downward direction. But notice on the Friday session, as the market perks up into the close here, that end of day rally, you actually have volume inflows at the NYSE. That's a small helping hand, but it is not, it's not picture perfect. Let's definitely frame it that way. You can see the same exact thing here in the advanced decline line all week. Most of the time being spent under the zero mark. Friday perks up and closes over zero, but we're not in trend higher zone. This shouldn't really be shocking information considering we know that the market is being driven by narrow breadth and simply the AI names pushing things higher. Semiconductors, NVIDIA, PLTR, like all these names are the primary drivers. Everything else has really been a laggard, right? The tick shows us the same exact thing. Notice the big bearish build on Thursday. I would say, if anything, if you're going to take away anything from the internals here, it's once again, why was it that on Thursday, after all morning consolidating sideways, right? This is just everybody's balanced, everybody's content. Why was it that with bearish market internals, sellers were unable to close the gap all the way? Let me go back to the spiders on the hourly. Let me zoom into this one more time. Thursday, we just saw incredibly bearish internals into the close. Why was it that sellers could not close this gap all the way. They closed some of it. I'll give some credit where credit is due, but there is zero structure here. This is a goose egg. The fact that with bearish internals they could not get the job done makes me hesitant to be a big aggressive bear. That's why I'm taking the neutral stance first and then leaning back into the higher time frame trends of still remaining a bull. Let's take a look over at the market profile for the ES. Another thing that is just incredibly, what would you say? Maybe, I don't want to say compelling on the long side, but it just continues to reiterate lack of strong sell side strength. And by the way, if you're not familiar with market profile, check out the video tutorial in the top right hand corner. But take a look at where value is on Thursday. I mean, come on, right? If stronger sellers are going to run away with this thing into the close, value has to shift lower. And it wasn't even able to break down hardly underneath the Wednesday FOMC low. Hardly there. And then what happens on Friday? Once again, value is unchanged, more so sideways than clean to the downside. Yes, the point of control has drifted lower here now 2 times. I will give credit where credit is due. I'm not trying to say that everything's rainbows and butterflies, but in the context of a higher time frame uptrend without stronger sell side indications, it is incredibly difficult for me to want to get short into this area of potential support. If you are initiating new money shorts at 674, I think you're missing the point of the analysis and the opportunity for a pullback higher low to develop. Let's take a look over at the NASDAQ side of things and see what's going on from an NQ/QQQ perspective. Let's bump up to monthly charts and let's take the same approach over here. I'm not going to bore you with the same thing about the monthly trend flipping to down and looking at the 2000 and the 2008 situations, but we will do the monthly analysis here. We do have solid green-bodied bar, much stronger close than that of the S&P in terms of range of the actual bar. They're still both similar in terms of structure, but the range is wider here in the NASDAQ. Bullish on structure, bullish on location, higher low, obviously higher high, higher close, a whole 9 yards. There's nothing really to say about this chart that's bearish. If we were to pull back here, clean opportunity for a monthly higher low. We could check in with some fibs, because why not? Let's come in from here to here, and the fib 38.2 has finally met us at confluence at the prior all-time high, closer to about that 545 area, okay? Let's clear that up, and I do want to illustrate, we were talking about the fib extension on the S&P. Let's do the same thing here on the NASDAQ, just to point out, this is why you can't just you don't just blindly trust fibs. If we were to layer analysis in terms of rank ordering importance, number 1 is price action always. Number 2 starts to become location relative to prior pivots. So let's say L for location. Number 3 is probably some degree of volume analysis, volume profile. You could be watching order flow, bid-ask spread, like the whole 9 yards. Volume analysis. Then number 4 might be something like market context. This is going to be your market internal. So I'll say MI for market internals. Everything below this is like indicators, moving averages, Fibonacci's would fall into this category. So you're not putting every bit of stock into the idea that the 100% retracement, or extension rather, excuse me, on the S&P is going to cause this manic crash and oh my god, everything's going to zero. It's just not even close to being the right argument to take here. Let's clear that up. Let's take a peek at let's jump into the weekly. And let's take a solid look at this. So a better close in terms of the weekly bar. Obviously, it's still an inverted hammer, but you do have a green-bodied bar, meaning that the close is over the opening price, which simply means that we opened here, rallied, and then the sell pullback only came, towards the lower third still of the weekly range, but not expanding range underneath the opening print. That's slightly more bullish here on the NASDAQ, although, yes, we have to acknowledge that there are some sellers stacked up here in the upper wick of the weekly bar. As we're thinking about the trend, obviously it's up. This is a brand new all-time high. A lot of the commentary remains the same. It's quite rare that weekly gaps go unfilled, but I would not encourage anybody to take the approach and say, blanket statement, all gaps must fill. That's usually not a good idea. If you've been short trying to get this gap to fill, I mean, obviously the chart speaks for itself. It's not the right approach to take. Now, we're still close to this gap area, so I would think that in the near term, it has a higher probability of closing versus if the market rips to the upside, we're 4 weeks later and we're up here, I'm not going to be carrying forward that this gap, oh man, I'm still short, I'm looking for that gap to close. Horrible mindset. That's not how you trade markets. So let's come in here with, let's check out the fibs. Why not? We know where these fall on the tier list, but let's come in from this low to the new all-time high. Oops, click. There we go. So the fib's 61.8 now, honestly, from this perspective, is even above the prior all-time high set. I really wouldn't want to see the markets pull back to this on anything other than the monthly time scale. That's deeper than a weekly pullback at this point. Instead, this is a multi-week balance range breakout, just like the S&P. Pullbacks over the top end of the box or pullbacks that hold the bottom end of the box. A-OK, no issues. So let's take a closer look at we'll finish up with some congruent studies like the weekly anchored VWAPs at the bottom end of the box. And here I'll give you that number quickly. That's 588 roughly. If we could stay over that, no problems on the weekly time scale. Let's come in with the volume profile as well, just to see where that high volume node is. There it is, weekly volume profile. And let's take a little zoom out. And where's this node? Just like the S&P, kind of straight through the midpoint of that balance range. So let's just drop it down to the daily, and let's take a peek over here at the weekly expected move and move from there. So you can see the strength and the relative strength to the S&P on the gap and go from both Friday of 2 weeks ago now, as well as the Monday open from this past week. And look at the fact that Thursday didn't even come close to the low of the Monday session. Again, not a shocker considering we just saw the weekly bar was a green inverted hammer, not red. So we're not underneath that weekly open. Instead, this is much more balanced up here. The other thing that I would point out is you can see there's a cluster, and it looks a little bit sloppy, and honestly, I'm not a fan of that, but it just is what it is. There's a cluster of stuff up here at the all-time highs. The bearish engulfer double has almost been hit. We were off by just a couple of pennies up there at the all-time high. It's 637.65 roughly. Okay, and then your all-time high is in there. I can't even read the numbers. That's how much stuff there is. Let me zoom into this so I can read it. 637 all-time high. The hourly level is just below that, 636.50. And then the overnight high, which is something that we have to carry forward in the NASDAQ specifically, there is an overnight all-time high that was made here at 638.80. Typically, all-time highs are not made in the after-hours session. At least, you can make it, of course, but that's not going to stick as the end-all, be-all, all-time high for this market. So I would expect that there is some structure to repair at the highs of this NASDAQ, and the auction is incomplete up at the top end. Let's go back to the daily, though, just to talk about our structure here. It's going to be very similar, of course, to the S&P 500. However, because this gap has not been tested yet, because there's much more range there to actually trade for, I would say that this gap close is definitely the short trade to be watching for. I would not really press my bet over on the S&P 500, and I would think more so if there is going to be a pullback. Let's think about the logic behind this move, right? And the catalyst and what I was mentioning in the intro. Right now, it's a very narrow breadth market. We know that. We're not shying away from that. That's why that signal fired. That's fine, but it doesn't actually change the trend. Now, if the AI names are going to pull back, I'm talking about NVIDIA, PLTR, all these names that have been on huge moves in the upward direction, the semiconductors, MU, TSM, right? If all these names are going to pull back, which of the markets, in terms of major indexes, is going to pull back the harshest? Obviously the NASDAQ. Which one's offering better structure to short through? As we've just outlined, it's the NASDAQ. So I would avoid the short on the S&P. I would be more of a pullback long in the S&P off the engulfer high. And then in the NASDAQ, I would be a short through the gap range to get to the engulfer high. Do you see how that sort of aligns with the narrative that if market breadth is the issue, if the narrow breadth is going to contract, you want to be in the place where it's most susceptible to inflicting the most pain, basically. So that's the NASDAQ to me, and that's what we can clearly see here on the daily timescale with the lack of gap close happening into the end of last week. Now notice that you actually opened on a subtle gap up on that Friday session. So we can flip the script and we could say, okay, if we had momentum buyers, or if we were truly going to squeeze out the shorts from the low of Thursday, this should have been a gap and go, test the all-time high, Brigade Bolt, you're rocking and rolling. Obviously, that didn't really happen. So in my view, buyers, as we've already pointed out, are definitely slowing down, but you don't really have signs of new money sellers stepping up yet. If we can spot new money sellers, the NASDAQ is the place to look for the short for this gap close to the downside. We're talking underneath 624 into the high of Friday from 2 weeks ago, 618.50, and then monitoring for continuation to see if we get to the true top of the bearish engulfer high. This zone back here is roughly around 613 on the QQQ. Daily 20 SMAs in there, and I know we didn't really evaluate the expected move, but it's sort of right on par, right? Lower edge 616.07, upper edge 642.07. Let's keep a closer tabs. Let's take a closer look at the hourly chart. I know we just blasted through it quickly when talking about some of this upside junk, but it's the same concept. Here is the spike base. That's almost, in terms of relative levels, it's the same thing as the Sunday low on the S&P 500. You tested that on the Friday session. Sellers failed to keep going lower. So as long as we're over the spike base, that's 627.65, I'd be neutral through here. I think the squeeze is on if we can do something like that and there's not enough of a catalyst Palantir earnings aren't really bad. Like, if there's no catalyst for the sellers to really latch onto and allow these semiconductors or just general breakdowns to take place across the market, you're talking about over 631.50 back up to the all-time high, right? So base case is consolidation neutral in here, willing to go with over 631.50. If we do pull back, look for the bearish consolidation. This is the signal that the trade is setting up, and then the actual trade itself is probably this. So break down to here, let it consolidate. This is then the trade. Bearish Brigade bolt A to B, and then once again, like the S&P 500, we have to remember the daily trend is technically up, the weekly trend is technically up. These are brand new all-time highs. So if this A to B is going to be a short, it's a quick short on the intraday. It's not, we're swinging for the fences here, the market's going to crash. And then instead, when and if we start to approach this zone, right? So in here, you might, here's one management tactic. You might take off 3/4 of the position there and try to run a quarter into the full closure and the daily 20. That would be fine. In here, maybe you take off an eighth, not willing to, completely get out of it. But why would you want to initiate a new short near a potential new area of support? I would not do that, right? So if you have runners from an upper short or a short from higher location, then that's fine. But I would not be putting on new shorts here. I would be evaluating for a possible higher low, as we've made note clearly, I think, on the S&P 500. It's the same concept here in the NASDAQ when we get there. So this short, more attractive than the S&P, but this long is equally as attractive as the S&P if we can find buyers to step up and offer a higher low. I want to be very clear here as well. If the market looks like this, let me just quickly do a little one of these. If the market looks like this, right, solid red-bodied bars, and there's a bar that closes through it like that, I'm not just layering limit orders in here and buying this blindly at the gap close. It's almost like I feel like I don't need to say that, but sometimes I read some of the comments and I feel like I do need to say that. This is not just a blind buy, but if we can find the structure that supports the thesis, I'm just going to draw this in as one line. If we can support this as a higher low, build out some structure, change the hourly trend back to up, that's fantastic. That is where I want to get involved. Hourly trend reversal, daily higher low, right? Perfect. QQQ mission accomplished. Let's quickly throw on the intraday anchored VWAPs, see what we've got here. Lo and behold, anybody shocked? You shouldn't be. It's the same pinch right through this area. If we get this, we know where the short is. If we get this, we're trying to lean more long. If we get down into this zone, that's where the daily higher low is. We could come in with the fibs just for the sake of congruency from the low up to the high. Lo and behold, 61.8, 38.2. Perfect. Let's leave it off at that. Let's take a quick glance over at the NASDAQ internals. What do we see over here? Much better volume inflows on that Friday session. You could call it end of month markup. A little bit of inflow or just, advanced decline line moving higher there. Cumulative build much more sideways than anything else. I do think, once again, if stronger sellers were going to step up, why could they not capitalize on that Thursday momentum? It just wasn't really there. And Friday, more so sideways than anything else. So the internals leave me a little bit more neutral than an outright bull. Oh my God, we're going back to new highs. I understand the breadth is weak. I understand that there's absolutely more of this short trade available in the NASDAQ, but it's not an overwhelming short. It's not an, oh my goodness, markets are crashing and burning and go to zero yet. We're hardly even in an hourly consolidation, never mind an hourly downtrend, never mind a daily downtrend, okay? Let's take a peek over at the market profile for the NQ, see what's going on over here, and whether or not we can make the same assessments with value area and where it's developed. So definitively lower happening on Thursday, or like middled in the range, but lower versus this, so breakaway to the downside. And then value on Friday, ironically, is actually higher. So anything to really read into there from a bearish perspective? Not really. More so balanced and neutral more so than anything else. Let's jump back over to the platform. Let's finish up the indices with our good old IWM Russell 2000 and the small caps monthly time frame to start. Let's see what's going on over here. So solid green-bodied bar-ish. A little bit more of an upper wick here on the small caps monthly bar than the other indices that we've seen so far. So the upper wick indicating some sell side pressure. We did technically close on the monthly over the previous all-time highs there. That's slightly more bullish than bearish, of course, but we do have to acknowledge that upside pressure. I would think that the main idea here is if this is going to be a weekly pullback over the top end of the range for continuation, then you probably just want to see the early stages of November build out an inside candle here and not really get much acceptance underneath the top end of those prior highs. That's around 245 on the IWM. Let's come in here with the fibs from the bottom of the April tariffs up to the highs. And what do we have on that? Fib 38.2 is in no man's land. I don't think you learn much about the fibs here. It would certainly suggest that a monthly higher low is still possible, but it would look like a failed breakout at that point as well. The best outcome would be that, yes, this builds out. It takes, another year or so, and then we ultimately go, I don't know, 2026 midpoint or late, right? Something along that in terms of timing-wise, if you are going to build the higher low. We shall see, but that is TBD. Let's take a look at the weekly chart. And this is where things are slightly different, obviously, than your NASDAQ and your S&P 500. Larger red-bodied bar in terms of candle structure, so that's bearish. Week close towards the lower third. There is a slightly higher high and a slightly higher low, but the candle closes back inside the midpoint of the previous week's range. And really this is building out as a multi-week balance. You could probably start from here and just say that is the major balance. And this has been a failed breakout in the upward direction. And we'll see this on the daily chart as well. In terms of your larger breakdown, that's going to be underneath these lows here at 237s. If you take out 237s, the weekly trend has the opportunity to offer a deeper pullback, which as we know is the top end of this range, closer to 225s. If we come in with a fib from the low to the high of this move, I think this is the same thing we were just looking at, yes. But the fib 38.2 is still underneath that level, so structure is most important first. Remember that hierarchy we just pointed out. Structure and location here, more important than the fib 38.2, but it would just reinforce that all of this, from this perspective, is still nothing more than just a bull flag on the high time frames. What if we come in from this low up to this high? Hasn't changed from, of course, 3 weeks ago. I know we didn't check in last week, but no change. Fib 61.8, line in the sand, looks good, and 38.2 still confluence with that 236, 237 level we were just talking about. Let's jump on into our weekly anchored view apps and see what we've got on the smalls. There we go. This is perfect confluence, and if we break, there you go, this is also starting to get pretty decent down here towards those prior highs at the 225s, 226s. Let's drop it down to a daily chart, and let's see what's going on with IWM over here. We've been keeping the IWM simple, trying not to overcomplicate this. It's really just inside the midpoint of this range. Okay, so my view of the small caps right now are that you want to be neutral through here, you want to be bullish up here, and then you want to be bearish below. It's really that simple. We're in a balance range in the midpoint. There's not much to really read into. This is a double failed breakout. You could, then start to call it a double top if you so choose. The neckline, of course, would be underneath the daily 50, underneath these prior lows. When and if that happens, we're in bear territory. So I think that this three-chunk segment, so to speak, is a very simple way to monitor your smalls. I think that they've obviously been much more sensitive to what Jerome Powell had to say on Wednesday. December's cut is not a foregone conclusion. Far from it, right? Obviously, small caps aren't going to like that. They were, of course, looking forward to rates coming down, way down, with all the super dove commentary from Fed Mirren now, but Powell walking that back a little bit makes that a little tougher for small caps to keep that higher valuation and, of course, trade at these elevated prices. So we shall see how that develops into the coming week, but for now, neutral on smalls, which as a proxy or just indicator for the S&P 500 probably keeps us in that neutral camp rather than being outright bullish. If small caps closed FOMC somewhere up here, closed the week somewhere up here as a little consolidation, then yeah, that would look great. Building out structure like this in the upward direction, possibly threatening an all-time high breakout, fantastic. Bring on the longs in S&P 500. But what's the reality of the chart in front of us? Okay, dial it back, Matt. There's no reason to have as aggressive as a bullish tone. And we know that the small caps can also be somewhat of a proxy for market breadth, right? It's 2,000 stocks here in the Russell 2000 versus the S&P 500, never mind the NASDAQ 100. Very narrow over there. So that's the commentary really on the smalls. Let's take a quick peek at the intraday hourly chart. Not much to really glean in here, chopping around the midpoint of the range into the end of the week. I think that you really just want to carry forward. If we rally and reject again, 248.25, we remain neutral. If we fall and support here, we remain neutral. If we fall underneath, bears start to build that edge. Maybe we start changing our tone a bit and looking for a deeper pullback in the S&P to the top of the bearish engulfer rather than just getting high and tight consolidation. Obviously, to also play devil's advocate on the bull side, this helps us build the narrative that the S&P may have an easier time. Easy and difficult exist on a spectrum. Trading is not easy. Understanding markets is not easy, but some things are easier and some things are more difficult. It will be easier for a bullish breakout if small caps were to get up here, is all I'm trying to illustrate, and it will be easier for a bearish breakdown if small caps were to get down here. That is the main illustration. Everything else is neutral in the midpoint of the range, and therefore trending style directional trades fall over here. You just don't want to get involved, really, in between the two ranges. It's going to be a much harder trade to pull off unless you have a balanced strategy selling something like iron condors, or if you have a good time or an easy time trusting the market and buying the lows, selling the highs, be my guest, do your thing. But for now, really neutral here out of small caps. You can clearly see it on the hourly. There's no edge inside this range. Let's get out. Let's get here. Let's do something. And then I'll have a more directional bias for the S&P and just general market implications. Let's take a look at the internals for the Russell side just to see if there's any divergence happening at the exchange. Not really an exchange, but you get the idea at the index level here. Survey says no, not really. No, I would say that these downside moves earlier in the week clearly outweigh what was happening here. Look at the net cumulative flows of volume on the week. Same thing with the cumulative build on the tick, and the advanced decline line very middled at the 0 line. There's really not much to read into on the Rusty. We can come over here and we'll see that value is just mostly unchanged, back squarely in the midpoint of that choppy range. Let's zoom way out on this thing. There you go. Look at all the sessions, and this is no different than the candlestick chart, just in a different visualization. But the point is that value developing here on Friday, squarely in the middle of this chop zone back to the left. The only thing that would have been interesting was that the point of control was left higher on the Wednesday session from the FOMC. So as a possible target, you could carry forward that if we were to move over Thursday's high, which is Tuesday's low here and here, that would probably be the place to go, right? The VPOC from Wednesday, which is at 25.31s. Right? So that is just a small nuance. I don't think it's a major trade that we're looking for, but it's just something to carry forward. When everything else is balanced, you look for the thing that, okay, here's one thing, right? That's it. So let's get back on over to the platform and let's take a look through our sector watch and see what's going on from that perspective. Let's kick this out to a S&P daily and let's take a peek through our sector. So, the conversation of breadth being an issue is very, very clear. The market went sideways up here at the highs. Everything fell except for the semiconductors, which are a segment, right, of the XLK tech sector. Everything else red. So real estate, thankfully a lightweight sector, down 4.15%. Staples, D for defensive, also lighter weight, down 3.81%. Materials, the lightest weight sector, down 3.71%. Utilities, lightweight and defensive, down 2.51%. You see where I'm going with this, right? It was a very red week across the market. Outside, if you were anything other than a semiconductor or loosely related to AI, red, right? So even some of these defensive names, as the market comes into this consolidation, aren't really rotating. You're not seeing financials catch a bid or healthcare catch a bid, none of this stuff, right? So very, very precariously propped up, which once again, we'll give credit where credit is due. The breadth indication signal, the omen, the Hindenburg omen, it's got some credence, right? It doesn't just fire randomly because, I feel like the market's a short here. It's based on data, and we can see the data here. The breadth is bad, right? There's no hiding from that. So the issue here will be if these semiconductors, if this tech sector pulls back hard, if we get a tech sector, an SMH, that's down 3% next week, and we don't see any rotation into things like, namely financials, healthcare, as well as discretionary, if those sectors can't catch a bid, I would even throw communications on this list. Where is our XLC? There it is, hiding in between. If those sectors can't catch a bid, oh my goodness, red flag, warning signs, and you'll hear me shouting from the rooftop probably on the Wednesday video if we're not seeing rotation and, this is hypothetical, right? And semiconductors and tech are pulling back hard. That would be a red flag. That would also probably mean that we're trading in or near this zone. If there's no rotation and there's no sign of buyers really stepping up, there's no 1 hour trend reversal, then we might not just be buyers here, right? The first thought is to look for bullish action, but if it's not being supported by the rotation itself and the actual price action on the underlying, then there may not be a buy. Now, I would like to see rotation. That's my personal preference to maintain the weekly uptrend, the daily uptrend here, but market doesn't care what I want. The market's going to do what the market's going to do. So we will monitor that in real time this week. Primarily, again, the focus here and why I'm talking about this before getting into the structural charts, this is, I believe, going to be the key for this pullback. If this pullback happens into the end of the year, this will be the key. What happens with the sector rotation? Let's get into those charts now. So clearly in the SMH, brand new highs, almost acting like a meme stock, gap and go, big down, doesn't phase this stock. It's not really a stock, it's an index, ETF, straight higher. So just nutty stuff. Now, obviously, like the index itself, the broad market, S&P, the NASDAQ, this clearly has this opportunity. But to get there, it probably aligns with the S&P as well. The issue will be, if this pullback happens and we don't have that rotation we just talked about, I know I might sound like a broken record, but this is key to understand. if that rotation doesn't happen and you get here and everything else still remains selling off, the S&P will overshoot its relative level. The S&P will not hold the bearish engulfer high if everything in addition to semiconductors is also selling. You need to catch that bid. You need to see that rotation if it's going to support. So although the trend looks okay here, understand the implications of getting all the way there without rotation for the index product. Let's jump into the XLK. No comment. Same thing. This keeps the trend up, but rotation will be critical. Let's take a peek at real estate, starting to threaten the bottom end of the range here. As we know, rates moving higher on, this is so classic, right? Jerome Powell technically cuts rates at the meeting, but yet rates go higher. Why? Because of the perception from the market, right? No cut in December. Oof, yikes. We priced the 10-year higher. The other thing to point out, and we've talked about this a little bit, that the 10-2 spread always sort of indicates that there will be about a point at least differential between the 10-year and the Fed funds, basically 2-year. If the Fed funds is going to 3% as the low, how could the 10-year be anything lower than 4%, right? So 4% is still probably the floor on the 10-year, which means that this probably still continues to play ping pong. If the 10-year goes higher, if we get more close to a two-point differential, then the 10-year needs to price to a 5%, which, oh my God, you're probably talking about real estate here or here, right? It's not happening yet, and thankfully this is a lightweight part of the S&P components, but it's something to watch out for. Wealth effect, I would say, is the biggest idea there. If we look at the XLP hammer here at the bottom, just a brutal move into the end of the week. 76 prior lows from the tariff debacle, and that's pretty wild to think about. But as of right now, what's the one takeaway that's somewhat bullish here? Nobody's really pricing a recession, right? If you're thinking about a recession, then, oh my God, everybody needs to buy healthcare and everybody needs to buy consumer staples, right? You got to live. So that's not really looking like an issue. Let's continue along to the XLB. Materials breaking down. We know that this probably goes hand in hand with the XHB, with the rates also moving up. Not a shock to see this. I would say that this is honestly holding on to an okay level here. This double bottom neckline from the weekly chart, as long as we could stay over this $100 figure, that might not be too bad. Might not be too bad in the XHB. Let's go to utilities. Starting to break down, but plenty of room to pull back into a higher low. So you got your head and shoulders. It's probably worth watching your energy names. Next Era has been on a nice breakdown here. But into this prior high is what you're just watching for. Do we get here? Do we start to build out some support? Can we catch for a higher low? It is a defensive sector, so if it does break down, it's not really the end of the world for the market as long as these sectors are performing fine. And primarily, the rotation's happening with financials, comms, healthcare, and where is it? Discretionary down here. Let's keep going. Financials, speaking of the devil, honestly, it does not look good. Really doesn't look all that great. Notice here that you do have, equal lows after breaking down and setting lower high and now lower high on the Thursday session underneath 52.90. So I'd keep a very open mind that financials underneath 52, yikes, we're talking red flag, and that rotation is not in play. Any pullbacks in the semiconductors and tech sector are going to be a huge pain point for the S&P. Let's go comms. Comms over here, couldn't really pull out of this on the earnings debacle headed into the Thursday open. So lower high underneath the moving average cluster now is not really a great look. Still persisting highs, lower highs now from a weekly perspective. The daily trend tried to flip back to up in here. That doesn't look great. So I would be concerned about this lower high happening. If you can get here early in the week, then fine. Maybe we flip to neutral. But as of right now, underneath 115.50, bearish. So once again, this breadth issue is abundantly clear as you start looking through the sectors. Let's take a look at healthcare. Healthcare had a nice look up here, completely failed on Wednesday, and is continuing to just balance off in here. So I wouldn't take a bold approach in this zone, and I would still think that this is probably a long as well over a multi-month high, right? Look at this chunk in here, 138.75. If this is going to do that, I'd be interested in long ideas in some healthcare names if we get a deeper pullback and the market remains somewhat... let's say from a fundamental perspective, it's not like, oh my God, everything's crashing and burning, right? You'd want more of a normal market to try that pullback in the XLV. Here is the TLT moving lower, as we know, rates slightly higher on the Powell cut, and the commentary there. XLI failing the all-time high breakout now once, twice, 3 times, 4 times, 5 times. So not really looking too hot here, but in a good sense, like spinning it in the positive direction. You're just still above the moving average stack. You're towards the top end of this balance range, so not worth throwing in the towel yet, but it doesn't look great. Energy, no comment, midpoint of the range. Let's move along to the discretionary sector, and that will finish us off here. Island reversal, abandoned baby reversal. I like that one a little bit better. The abandoned baby down here was a threat. Really weak close on Thursday. Obviously, the gap up on the Friday session, Thursday after the close earnings from our good friend Amazon, sending this thing higher. It's helpful. The abandoned baby now means that you can't really afford to go back down underneath the moving average stack at 236. As long as you're above that, this may continue to build out. It's sloppy, but it may continue to build out ascending triangle. You could even call it inverted head and shoulders as a right shoulder here, pie in the sky, and Brigade bullets to the upside certainly help. Tesla all-time highs would also help. It does not seem, we'll get to Tesla's chart obviously, but Tesla's just been rough. It can't seem to get in gear and catch that wind for its big 7, 9, 10% up day like it has every once in a quarter. We're just not there yet. So we'll monitor the situation, but for now, that is your sector look. Let's take a peek through the actual ratio charts, see what's going on with these. If you're not familiar with ratio charts in Thinkorswim, check out the video tutorial in the top right-hand corner. This continues to be the glue holding everything together. Nice rebound here on the XLY from the gap up on earnings, but still in a downtrend underneath the daily 50. No dice on the XLF, no dice on the XLC. This at least isn't risk off. This at least isn't risk off, and this at least isn't risk off. So we know breadth is the issue, and the tech and semiconductors are the only thing holding this market together. If we take a peek at the specialized ratios, it's not a shocker here. I mean, this is the XLK, this is the XLK, this is the SMH. These things are all heavyweight risk on. You know, it's the narrow breadth component. So of course this stuff looks risk on, but even this looks pretty darn good. This is a little bit more apples to apples. XLY, XLP looks pretty darn good, making a new high here into the Friday session. ARK-K could use some improvement out of this bull flag. If it breaks, that will continue to look like a risk on indication. If this starts to fail the daily 50, yikes, that falls into the continued narrowing of breadth, so to speak. IWF, IWD, really strong look here, risk on in the small caps, or just more broad-based measures of market participation, which is kind of interesting. Excuse me, thinking about the conversation we've been having thus far. I do believe, though, I might have to click this up in another tab as I'm talking to you. IWF top holdings. I believe there's NVIDIA in there. Oh, yeah. Okay, this is why. Yep. So iShares, that's the Russell 1000 growth ETF. It does technically have NVIDIA, Microsoft, Apple, Broadcom, Tesla, Amazon, Meta, and Google. Okay, so those are among some of the components in the IWF, which of course that's part of that issue with the narrowing of breadth. So that's why it looks that way, even though it's part of a Russell component, which is a 1000 ETF rather than a select, 50 or whatever it may be for the Spider Selects there. Let's get into the Dixie, see what's going on with the dollar. Obviously strengthening up here a little bit on the prospect of no rate cut, higher rates based on Powell's commentary on Wednesday. And if we take a look at the inverted ZT, you could see, actually, I think we missed the B set. We missed the B set, my apologies. This, of course, includes gold. So gold started to neutralize and stabilize, I should even say, a little bit. I have inverted this ratio here. I thought it made more sense to, if this is pointing in the upward direction, bullish. If it's pointing in the downward direction, we want to be bearish. So rather than dealing with the mental tricks of trying to invert that, here you go. So looks good. Higher lows, boom, boom, boom. Looks fine. All-time highs, not all-time highs, but equal highs. That breaks out, continuing to indicate risk-on sentiment for the market. If we look at Bitcoin, not so much. You can see it's kind of neutral in here. Has recaptured the bottom end of this range after that route to the downside here. I don't think it looks compelling for a breakout or continuation. I'm more so neutral on Bitcoin right now, so risk appetite there coming down a little bit. Here's that inverted ZT, though, after rates and the dollar. Clearly higher on Powell's commentary about the December cut, which, speaking of, let's just go take a look over at the Fed Watch tool. You can see over here that the odds have decreased to a 66.8 for the December cut. And if we take a look at what the odds were prior to, some smart guy over here decided to take a screenshot. It was 97.8. Sorry, that was the October cut that we just got, but rather here, 85.2 on the December cut. That was pretty darn compelling. And the other thing to point out too is look at this deeper expectations of cuts, right? You're talking about 300 here. Let's go back over. Notice how now there's just 125% chance that you actually make it there in April of 2027. I mean, come on, let's be real here, right? So it's looking like a much flatter curve here rather than a steeper curve to reduce rates at the Fed funds. Now, of course, part of the commentary from Powell on Wednesday was that basically QT is coming to an end and they're going to freeze the size of the balance sheet. And if that's going to remain stable as a percentage point, right, they actually need to technically add. So what does that mean? I mean, indirectly, he sort of said it's not going to be QE, like let's throw the money printer on in full blast, but they will be stimulating, or I shouldn't even say stimulating, but they will be providing some liquidity, right, rather than literally reducing liquidity via QT. So that is the other important take from the FOMC, which happened on Wednesday. Those are the two big points. It was that Jerome Powell was a bit more hawkish than the market expected. However, in the same breath, announced that they will be accommodative with their easing in quotes versus vacuuming money out of markets, right? Let's jump on over to the calendar here. There was the FOMC, not really much to talk about on this. Let's go forward to this upcoming week. Don't forget to flip your clocks back, fall back. So daylight savings headed into Monday, but ISM manufacturing, this is a private number that will be released on Monday morning at 10 o'clock. Be aware of that. We also have the JOLTS. That is going to be tentative, so probably not. Strike that one through. So Monday morning, let's deep breath. Monday morning, ISM manufacturing. Let's watch that one. Tuesday, nothing. Then Wednesday, you get a taste of labor data. This is going to be interesting, simply noting that the market has been starved of labor data recently. The ADP does also release a Tuesday number, but this 8:15 on Wednesday will be the one to watch this upcoming week at least. And then over here, the ISM services PMI will also come out. And remember, ISM on both this Wednesday services and then Monday manufacturing, there is an employment part of that number. So the market should look forward to that. Also, just noting that we will get a little bit of this private data. The government numbers aren't coming out. And again, probably until there's a big change, so let's just strike through all of this government data commentary, like nothing. None of this is likely to come out. So when and if the government reopens, we could think of this as a possible catalyst for the market. There's nothing right now, right, that's bullish, but or I should say there's no teed up catalyst that the market's pre-pricing as bullish. Maybe Palantir earnings, but aside from that, when and if the government numbers start to flood and overwhelm the market, maybe that's a situation where we start talking about that daily head and shoulders over on the S&P. We're just not there yet, so it's speculative at best. Let's jump into our earnings calendar here. We know it's all about really a handful of names. I would say Palantir, HIMS is in the gutter. They totally, the CEO messed up that breakout big time. And then aside from that, I'd say Shopify is always interesting to see what's going on with small business, see what they have to say about how small shops basically are doing, online shops. AMD will be critical, of course. Semiconductors, super micro falls into that category. What else? ALAB, rather. Astera will be a big one. Beyond is just on the backside of its squeeze. I would avoid that. Probably, this has been interesting recently. A lot of talk about race, Ferrari, see what's going on with the higher end consumer there. Not really interested in much of this here on Wednesday morning. Robinhood will be a big one, of course. IONQ, AppLovin, those two. Qualcomm, ARM. Fig I'm interested in, but not necessarily for a big break. D-Wave, so just more quantum name here. What else? Datadog probably gets an honorable mention. Trade Desk, yes. Open Door, maybe. Eric Jackson, right? That's the guy's name. His next 1,000-bagger, we'll see what that is. SoundHound, AI company. I think that is flying under the radar for a lot of people. SMR, New Scale, interesting. And Constellation Energy. Yeah, there's a handful of names. Obviously, it's not so much Mag 7 here this week, but if you're like Matt, enough with the BS, just like point to the one. I think everybody can agree, right? It's here. It's Palantir. Monday after the close, everybody and their sister's brother's mother will be watching Palantir as a proxy for what's going on with AI spend. Remember, they are not making the semiconductors. They are implementing AI and selling AI contracts, and that, I think, is a more pure view of, think about the gold mine analogy, right? How many people are actually finding gold, finding gold and panhandling for gold? How many people are finding gold versus how many people are getting rich selling picks, right? That's the same analogy. So Palantir is the gold miners, not the people who are selling the picks. NVIDIA, AMD, the whole nine yards, the chip designers. Let's jump on over to the earnings insight report. So what we've got so far from the FactSet report is that this has been a killer start to earnings. S&P reporting double-digit earnings growth for the fourth straight quarter. You can pause your video player and read this at your own leisure, but I would just point out here at the sector level, this is what caught my attention. Financials have been the largest contributor to the increase in earnings for the S&P 500 since September 30th. That is interesting because I think a lot of people were thinking it's the AI semiconductors, the whole nine yards over here in Infotech, XLK. So what I would start thinking about is what is going to happen with the, I think there's a lot of innovation, and this is a little bit more fundamental, and this is definitely my opinion. This is less of a objective fact based on the charts, but I think financials are sort of ripe for a revolution, so to speak, and it's always been this way a little bit, but I think we're getting closer to that point. Not to sort of piggyback on Tom Lee too much, but I do agree with his view that the financial industry could be overdue for, I don't want to get too deep down the rabbit hole of tokenization. I'm not like a super mega crypto bull because of this, or even a financial bull, but I do think that as a sector, it does look promising. Also, all the deal-making M&A that's going on right now, private equity, there's some issues in some sore spots of private equity, but that generally, I think, is being reinforced by what I'm seeing here at the sector level, right? So financials leading the sector charge. As we scroll down, I just want to go down to the very bottom where our charts are. I just want to illustrate a couple of things over here. Where are we? Getting closer. Right about here. So aggregate earnings continue to move in the upward direction. So as earnings increase, this market has also gotten more expensive. Let's take a look at PEs. Here we go. So 12-month forward PE. Take a look at this. All I would say is that if you're skeptical because of PE remaining elevated, remember this is 2020. How long did the market rally for? Until the big, I wouldn't say crash, but the bear market of 22, right? This is all rally activity. This is an expensive market, but you are paying an expensive premium for companies who have massive margins. I mean, go look at the NVIDIA earnings statement and tell me that it's a bad company, right? You might not agree with the multiple, but you are paying a premium for a good company with like an insane business model, basically. Their profit margin is huge, right? They're basically a money printer. So with that is the commentary on earnings. I don't think that, the earnings look here kind of to me reinforces that we're not quite in bubble territory yet. People are probably going to have a strong reaction to that. This is my opinion. I'll tell you when I'm talking opinion versus objective fact about a chart. That's my opinion. You're just paying for really quality stuff as of right now. It seems like early innings, or maybe not even early innings, but midway innings before things get too crazy. And companies, I mean, you look at OKLO, right? OKLO, no earnings, trading at a huge valuation. You could look at your quantum. That stuff was a bubble, right? Is NVIDIA a bubble? Probably not. I think I would distinguish between the two. And honestly, my man Jerome Powell said just about the same thing on Wednesday. Let's get back over to the platform here. Let's finish up today's episode of the weekly watch list by finishing off our supporting evidence categories. These things moved higher as Powell became slightly more hawkish, but not in a concerning manner. I will tell you when and if I have a new conclusion about that. This we give the benefit of the doubt. This we do not. I would say that this is still in a downtrend and therefore still okay on credit spread proxies. If we take a look at the junk bonds, they continue to be an issue. Let's go SPX down here instead of LQD, and let's just take a peek at this. You have a much weaker HYG than you do SPX, right? See how deep of a retracement this was, just the slope of the line. This has been a great sort of leading watch, if you will. Notice this. It's very nuanced, but from here to here, lower high, from here to here, higher high, even if you just want to say equal high, that was a leading indicator of the pullback to come. The HYG has been spot on over the last couple of weeks. I would really pay attention to this as we continue into this upcoming week. Let's take a peek over at the breadth of the market, which is not going to be a shocker, right? We know it's pulling back here, we know it's pulling back here, and we know that new highs versus lows has technically gone negative. This is not a shocker, but we know that the technical structure of the index below is still okay. When and if the index structure deteriorates on bad breath, we will look to change our tone. We are just not there yet. If we go RSP, you can see we're still inside this range. I actually have my alert set. If we take it out, I want to be aware of that. I want to possibly be able to change and drift with the market. But for now, we are holding on by a thread. Let's go QQQE. You can see even stronger over here on the QQQE versus the RSP comparison, where we're just at the engulfer high. If we go back over here to the RSP as a quick illustration, there's your engulfer. We're underneath it, right? So that is what we've got out of breadth when it comes to the equal weight indices. Here's the VIX, small uptick on the Friday session. This is a tough one. I would have thought that after the earnings season of the big Mag 7s, obviously we still have NVIDIA down the line, but after Mag 7 earnings, I would have expected this to come in a little bit. It just didn't. We did get a number of catalysts, or just like, not arbitrary, but some headlines from the administration. Venezuela was on, then it was off. And then it was, we want to remove tariffs on China, and then things are probably going to move in a better direction with China. And so, like, there's a lot of tumultuous headlines from Air Force One on Friday. I think VIX is maybe responding a little bit to that. But aside from that, really not in a concerning spot yet. VVIX also struggling to close over 103. So I mean, it's right there, not a full-blown red flag yet. I think more of these data points point towards neutral. I might dial back my tone from being like mega bull to neutral. And even open-minded to a trend change when and if we have the proof, but just not there yet. Still in contangos across the board on the VIX futures, still here on the 9 versus 30-day, and the one-day VIX kind of elevated. Again, I would have expected post-earnings that this could have came into this, but with an open at 745, just not the case as we came into that Friday session. So watching early this week, if the VIX one-day resets to 745 on the open, that would be an indication that, probably don't want to take more of a bearish approach to the market than need be. Let's just reset this. I'll put that like that for Monday, and then we'll go over here. Let's reset to our core list of companies, and then I've got 4 additional ideas to share with you. Here's NVIDIA. NVIDIA looks precariously propped up, right? Obviously, earnings are still further out. They're not an issue for this upcoming week. We could trade the weeklies and be all set. Under 202, yeah, absolutely, right? I could see the path for a pullback in the market. It's not like it's hard to see this. Right? If you take out that Thursday low, if you take out the high of the Jensen keynote speech, you're probably talking about at least a move to the prior high, if not deeper to this value and this chunk of prior structure close to 189.50. If we take a look at the hourly chart, definitely a lower high coming into it. You could start to make the argument for descending triangle, but then of course someone could contrarianly say, no, it's a bull flag, bull pennant. I get it. I would be more apt to say if the market feels heavy and we start to take out 202, I'd be open-minded for the thin structure retracement. What goes straight up usually comes straight back down. That might be a decent short watch early on in the coming week. If we start to bounce here and just hold up, I would avoid in the midpoint of this range. Really don't want to get involved in the structure there. Let's take a peek over at Microsoft on earnings gapping down after the OpenAI restructuring gapping up, just kind of all over the place. The big concern is that this maybe will be weekly double top. I know I'm talking about it, but it's only a concern when and if we get this underneath 500. 500 is just a huge psych number as well. So when and if it shows up, fine. But for now, I would think that if we could stay over this 518.50, somewhere in here, we're kind of trying to keep this trend line, right? If you strike a trend line that looks like this, you're trying to keep that uptrend alive. The weekly bar is horrific. It's a really, really ugly week of action on Microsoft. Honestly, I would not even be inclined to trade this in this bubble back here. Not, the drawn bubble that I've drawn. Not this... Not the range. Don't bring me back to the range. Stay over the range. So we shall see. But 518.50 is the big number on Microsoft. A lot of these old guards of tech just have not been interesting to trade recently. And if you're having a good time, then kudos to you. But October, not really it. I do like Apple. A little bit more tame on the gap up. It's faded the gap and just come back down to a reasonable chunk of consolidation. If we take a look at the hourly, you can kind of see this. There we go. So the Stevie Wonder trade is definitely on the table. If we do this, yeah, over this 272.50s, squeeze out shorts who got involved here. Look for the long back up towards the all-time high. Absolutely. So that's 272.50. If we take out the low, I would just let it be through here and then probably look to seek pullback longs off of this gap close from over here. That is 264.65, 264 flat on the gap fill. So again, let it be. If it drifts, if we get here and show signs of buyers, I want to be a pullback long off of 264. Previous highs act as newfound support. Let's jump on over to Amazon. Big gap up to blue sky territories. Here is your previous all-time high. Finally, Jeff Bezos not selling the stock there. Goodness. So it did fade nonetheless, but if we can catch support at the previous all-time highs, that is where I'm interested in possibly building out a long. If we do something in here, any of these levels really go. So I would be open-minded to, I'll just rattle them off real quick, 242.50, 241.10, 238.75, and 237.50. Any of those levels go. If we can catch support near them, I would be looking for the higher low and continuation, generally based on the premise, if we go to a weekly chart, that this looks pretty darn good. I mean, if this is like, you could even just call it cup and handle, whatever you want to call this thing, beautiful break, all-time highs, finally getting out of this range. Can it catch a bid? Will it be supported? As long as Jeff Bezos doesn't sell some more stock to pay for the wedding, I think it'll be all right. Let's take a look at, next up is going to be Google. Nice gap up to new record highs. And note also, a lot of these things have unresolved all-time highs in the overnight session, so carry that forward. Very clean chart, very clean trend. If we get anywhere close to this previous all-time high 255, that's the best place for some structure to build out for a long. If we're just consolidating up here, have to just continue to go with. Really strong. Google has been an absolute A+ over the last little bit. Of all the companies in the Mag 7, Google has really pulled it together. They had some issues, if you remember, way back over here with the whole Gemini model that they were developing, issues with Gemini, and so on and so forth. But when it pulled out of that, when it finally got out of this junk down here, really, it's been one of the cleaner charts as of late. So looking pretty darn good on the Goog as long as this trend can remain, and that is higher lows over any of these reference points that you see. There's not much to read into on the hourly, right? There's nothing to really read into here. There's nothing to read into here. It's that prior structure, daily 20. All right, let's keep going to Meta. Meta, huge gap down. Zuckerberg, one-time fee. Better be one time. That's what the market's saying, basically. I'd be interested in Meta when and if it can recapture its daily 200. Obviously, Friday's close is not compelling at all for that. But if we were to get something like this here, I would want to add longs on Meta back into this range. You could call it look below and fail, target top end of the range. That's one possibility. The other possibility is if it just drifts off into oblivion, let's reevaluate at the gap close down here and then see what happens with the April tariff chunk, right? Do we find any support down in the zone or not? So I'm sort of one day at a time here on Meta. I don't really like the structure that we're coming into. I don't love this down here. I would think that the best long is just show me the sigh of relief, strength back over the daily 200 is the long. Let's go to Tesla. Multiple failed breakout attempts. It depends on how you want to define failed. Some of these moved, but many of them didn't. Definitely doesn't have the momentum, definitely doesn't have the volume. Look at this, and then look at this, right? It's just not there. Look at the volume increase on the breakout. Look at the volume taper on the breakout. So you're not really there yet on Tesla. I think that the next idea here is just, this is now the junk drawer. The junk drawer was just this little segment here, and we were looking for thin structure retracement. It kind of happened, but now we're just kind of stabilizing. The next big break is over the top end of the bear engulfer from back over here. Okay, so simply put, over 470.75, maybe it starts to go. I could envision a morning where there's a catalyst, some news or something, Optimus robot, battery, something, anything not related to the car, basically. And if we open here, right, with high volume, a lot of interest in the overnight, and then we start to break, first 5-minute bar gets us here, right, good volume, high and tight consolidation, boom, all-time high breakout. Maybe with the right catalyst, like you can envision it, you could plan for that, you could have a game plan ready to go for Tesla, but you need to see it to believe it. I'm not just putting on that trade like Monday because I think, oh, it's going to happen. No, you need to see it to believe it, all right? Let's go to JP Morgan. What do we have over here? Financials, again, looking good. We saw it on the earnings report. For now, midpoint of this range, if we could stay above, looks pretty darn good. No problems, high or low, good. Nope, all set. Trying to build out a grindy, yes, grindy, but it is an uptrend. All right, let's keep going to Palantir. Earnings on Monday, so I'm just going to refrain from big commentary here. It's broken out of its junk drawer. It's finally gotten over the previous all-time high. This would be the best situation, but once again, here's your red flag. Anything goes post-earnings. We will reevaluate once the numbers are out. Let's go to Broadcom. Looks pretty good on a pullback over this spot right here. So watching 359.25 from the daily perspective quite closely. If we go to the hourly chart, you can see this breakdown. If this lower high is going to get us there, it could be a short early in the week on call this double top here, 1, 2. If we double top this 372.25, taking out this low, could open the door into the full pullback level at 359.25, which we just saw is a daily higher low, a DHL shipment. So that's Broadcom. If it just recovers here, let it be inverted head and shoulders, and then here to the all-time high. That's it. That is Broadcom. Let's keep going to AMD, another earnings candidate this week. So once again, anything goes on earnings. Really nice high and tight consolidation. If it didn't have earnings, I would be pretty interested in a possible break, for something that does this, or even just consolidation over the all-time high and goes intraday on a 5-minute chart or something like that. Looks pretty good. If it does break this low, this is also a pullback long off the daily 20 and the top end of this breakout level from back over here. That's 242, 240.35 is the hourly level that we parsed out from these prior highs. Again, earnings on, what did we say, Tuesday after the close? If we just go back over, where is the window? Let's do this, Tuesday, yes, Tuesday after the close here, AMD. All right, let's go back over. Oh, my tab is all messed up. There we go. So that's AMD. Anything goes on Tuesday. Let's take a peek at Robinhood. Robinhood, also an earnings candidate, so be mindful of that. A little bit later in the week, what did we say? Wednesday. My tabs are still all messed up. How is this happening? Let's go here. Wednesday after the close. So you could probably trade shares. I would still stay away from options early in the week. The options chain's getting it all messed up because of IV, obviously, so steer clear of that. But really nice recovery effort. Actually, maybe not nice. Let me reframe that. Not a nice recovery effort over the conjoined twins neckline, right? You have your double top here, your double bottom here, shared neckline. This Thursday session, choppy. If you go back and look, it held in the morning and then it failed, and then we gapped up, and then we just never looked back. So I would be a little skeptical of Robinhood. It has not been as clean as I would have liked. If it does pull back, it could still set a higher low over that 141 neckline, but one step at a time here. Earnings leave me a little bit more so open-minded to just pedal off the metal, not pedal to the metal, and we'll just let the numbers come out and see what happens with it. So it's going to be another week, at least early on in the week, to let some things settle down and let numbers come out and develop a better plan for the market rather than just, oh, it's a new month, let's go full portfolio, long everything, short this, long that, and still the same mantra of letting the market develop some better structure before we really start to participate. So let's get into some charts that do have a little bit better look. Let's go Oracle. Oracle's the first trade idea here. The idea is that the possibility of the remainder of the gap close could come in off of a bearish 3-bar play. That's Friday, inside candle, upper wick, rejecting those highs. Even if this rallies, you could set a daily lower high here at 271, rotate back to the lows, or just consolidation here. Then the idea is Brigade bolt underneath 258 to get down into the full gap close there, right? That is Oracle downside. Just generally, you just watch for price acceptance under 271. Look to close the gap. That's the name of the game on ORCL. Next up, WFC, financials. Wells Fargo looks pretty darn good. Huh? How about that? 87.45. Over that, you're talking about blue sky territories on Wells Fargo. So watching WFC, simple, straightforward chart. Next up, MSTR. Let's go strategy, which is no longer micro. Lower high underneath these prior lows. That level probably just deserves to get bumped into it graduates to a solid line. There we go. So 278.50. As long as lower highs are underneath that, you can see I've got my alert set. If we're underneath, looking for continuation to the downside, highs, lower highs, lower highs. Earnings did this, no help. And I think Sailor's kind of falling out of favor, and the crypto boys are sort of falling out of favor here with the most recent action. So 278.50. If we stay below, I'm looking for continuation lower. Let's take a final look at, we mentioned it earlier, OKLO. There it is. They have earnings further out here. However, what day is that? That is on the 11th, so not this week, but next. Look at this thing. Head and shoulders starting to develop ahead of earnings. No pun intended. Break the neckline, which is basically the bottom end of the balance range. And I would think about this equal low in here. It doesn't even need to be labeled previous all-time high anymore, but you get the idea. Coming into that as a more flat level, equal low, under 130.40, 110.75. Something that looks like this. Well within reason, I think, after it's failed, really on Wednesday, to break over the daily 20, get over this inflection point here. Can't do it. Buyers just cannot do it. So do the sellers have what it takes to rotate this back down into the flat level, the daily 50? Do we get a breakdown from this balance? It would be a beautiful range double. So that's 130.40, 110.75. And that's going to do it for today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. I know I missed you last week, so do me a favor. If you've got someone that you usually watch these videos with, share it with them. Send them the link. Say, hey, this guy's back online. He's sharing his ideas. We missed him last week, but he's back in the saddle. He's back in the office. He's back on the East Coast. And as always, we're getting the job done. So have yourself a fantastic and green trading week. And as always, once again, I will see you in the next one.